Hello everyone, this video will be an introduction to inventory costing methods. What exactly is an inventory costing method? Well, for a retailer, the price of goods is going to change all the time. Everything usually gets more expensive as time passes. It's very common that a retailer will have multiple units of the same type of item on their shelves where each unit didn't cost exactly the same. Let's say in our example here that Costco buys 1,000 packages of Kirkland bath tissue from a vendor for $1 per package on January 1st. They need to go and buy more to stock their shelves, so on January 2nd they go back to the vendor, and the vendor now charges $1.05 per package. Well, this presents a conundrum when someone goes and buys an item, because we know that we expense our inventory at the time that it's sold. So if a gentleman goes in there and buys some of this Kirkland bath tissue, the problem we have is the package that he is grabbing a $1 package purchased on January 1st or a $1.05 package purchased on January 2nd? There's no easy way to trace this for items like bath tissue because they're all very similar. You're going to have a large quantity on your shelf. It would be an accounting nightmare to assign a cost to each individual package and check the number of that package when you check out to make sure you have the exact cost for an item like bathroom tissue. So what do companies do? They choose an inventory costing method which approximates the flow of inventory. There are 4 methods. We'll go into them in greater detail one by one, but the 4 prominent methods that companies use are the first in, first out, or FIFO method, the last in, first out, or LIFO method, the weighted, or sometimes called moving average method, and then lastly the specific identification method. For the first in, first out method, you don't track each item individually. You don't know when someone comes to the register with an item of inventory exactly how much that cost. You're going to assume, and under the first in, first out method, you assume whenever a piece of inventory is sold that it is the first one that was placed in your inventory, or in other words, it is the oldest unit of that type that you have in inventory. So for our example, when this customer grabs a package of bath tissue, is it a $1 package or a $1.05 package? Well, it's the oldest one that you would have in inventory. So for us, it would be one of those $1 packages that were purchased on January 1st. It's possible, actually, physically, that, it was a January 2nd package, but we don't care about tracing item per item. We're just going to assume, and since we're using the FIFO method, we assume it's the first or oldest package of bath tissue which was placed on the shelves, and when we expense this purchase, we would expense it at $1. The opposite of that is the last in, first out, or LIFO method. Again, we're not going to actually track each unit to its exact cost. We're going to assume, and for LIFO, we assume it's the last one we purchased, or the most newest piece of inventory. So when this gentleman buys a package of bath tissue, is it a $1 package or a $1.05 package? Well, the newest piece of inventory we have are those $1.05 packages that we purchased on January 2nd. So when we expense that inventory, when it is actually sold, if we're using the LIFO method, we would assume it had a cost of goods sold of $1.05. For the AVCO method, again, you don't track inventory piece by piece. You're going to assume a cost whenever a unit is sold, and under this weighted average method, you assume that every item being sold is sold at the average cost of all of that type of unit that you have in inventory. So I set these numbers up to be nice right here. We have $1,001 packages. We have $1,001.05 packages. When we sell, we assume that it's going to be sold at its average cost basis for all of the Kirkland bath tissue that we have, which would be the midpoint between these two, or $1.02.50. That's the cost of goods sold that we will record when this gentleman checks out with a package of Kirkland bath tissue. There is a method which actually ties unit per unit to its cost. It's not an approximation method. It is the actual cost of each unit that you have. But to be able to do this, it's not feasible when you are a BJ's or a Target where you have hundreds, if not thousands, of the same item in your store at any given time, and they all look the same. For a specific ID to work, you need to be selling large ticket items in small quantities, which you can easily trace to their cost. And the best example of this is cars. All cars have a VIN number on them, which makes it identifiable from every other car of that make and model, which means when you sell a car, you can just run its VIN number through and you will have your cost of goods sold or your cost basis for that car. Another example would be high-end jewelry. You go into K's or any other jewelry store. It's not like they have tens of thousands of items in there. There's a small amount of very expensive jewelry sitting in their shelves or sitting in their display cases, and they can track exactly what the cost basis was for that diamond ring or that amethyst pendant based upon when they had it. So your specific ID method actually gives the best picture of what your cost was, because it ties a cost to each unit in your inventory. But it only works in this scenario when you are moving large ticket items in small quantities. You can't use this method if you are a Walmart or a Costco, where you just have tens of thousands of items of inventory on the shelf at a time. So what method should you choose? Well, companies are free to choose whatever they want. You can be a FIFO company, you could be a LIFO company, you can be an AVCO company. If you have the right, sales model, you can be a specific ID company. You can choose whatever you want. But once you choose, you're stuck with it, at least for the foreseeable future. And I call that the gap consistency rule. You can't say, all right, in January we're going to be LIFO, February FIFO, March AVCO. You can't keep changing your methodology like that. Once you pick one inventory valuation method, you have to stick with it for a good long time. And if you do choose to switch in the future, you need to inform the public, anybody that would use your financial information, that you are indeed switching, and you have to provide a rationale for why you're switching, and you have to go through and show some of your old numbers from the last few quarters or months that you reported, what they would have looked like if you were using, say, FIFO, which you're switching to, instead of LIFO, which you were using back then. So switching inventory valuation methods is kind of an accounting nightmare. It requires a lot of work, but there are reasons that you would do it. The big deal with inventory valuation methods is you should choose a method that approximates the flow of your inventory. If you're selling perishable goods, you're going to assume that you're selling the oldest ones first, because if you don't, they're going to spoil. So you should be a FIFO company. But things don't always work that way, because a trend happens between the three major methods of FIFO, LIFO, and AVCO that companies have caught on to. See, with FIFO, you're selling the oldest inventory first. Well, the price of goods constantly goes up. So when you are selling that older inventory, it's going to be the cheapest inventory that goes out first, which means you're going to have the lowest cost of goods sold. And since you have that lower expense and the same amount of sales revenue, it's going to result in more income. So you're going to report higher income on your financial statements. But when you have higher income, what do you pay? More taxes. So for the FIFO method, it gives you the highest income. It also exposes you to the highest tax liability. For LIFO, you always sell the last item that you assume that you sell the last item that you purchased first, which would be the most expensive, because the price of goods is constantly going up, which means you're going to record the highest cost of goods sold possible. Highest expense is going to give you the lowest amount of income, but when you have the lowest amount of income, you pay the lowest amount of taxes. And AVCO is always going to end up in the middle between FIFO and LIFO. And with this trend, companies choose the method they want that's going to present their numbers in the manner that they want to show investors or lenders. If they want to have high income to secure a loan, well, going with the FIFO method gives you the highest amount of income. If they are comfortable in their financing, they're not going to need money individually, and their investors are happy with the income that they're reporting, well, then the best thing you can do is not pay as much taxes. So LIFO reduces your taxes, and that's the big catch right here. Because LIFO reduces your taxes, it is by far the most popular method for companies. Over 90% of companies report in America using the LIFO method, so they don't have to pay as much tax. And I say in America because you used to be able to choose LIFO anywhere that you wanted to in the world, and everybody would pick it because it lowered their tax amounts. And international financial reporting standards, or IFRS as they call it, which governs the rest of the world besides America, it's like, that's enough. Everybody's reporting LIFO because they don't want to pay taxes, and they made LIFO illegal. So LIFO is used by pretty much all American companies. It's illegal to use it anywhere else in the world. So that's the background information, but how do you actually track what your cost of goods sold is going to be on every sale? Well, you use a thing called a perpetual inventory record. And a perpetual inventory record tracks the purchases, sales, and amount of inventory on hand at any given time after each transaction for a particular item. So in this case, we have item 46, which is lava lamps. You're going to need one of these for every different item that you sell. So who knows how many different items. If you've got 500 different items on your shelves, you're going to have 500 perpetual inventory records. And doing this will allow you to calculate how much cost of goods sold you are going to recognize on each sale for each item based upon the flow of that item's inventory.